Hi guys, it's Sam and welcome back to our YouTube channel. Or if you're new here, my name's Sam and I'm the founder of UK Mortgage Centre. Now in today's video, I'm going to be breaking down the different types of mortgage products that might be available to you. But before I do, please do me a favour, go ahead, press the subscribe button and help us reach our channel targets of over 1,000 subscribers. And you'll also not miss any reviews or videos or uploads. Reviews, I meant videos, along the way. So let's get you started. Now I'm going to start with one that you might have heard of the most, a fixed rate mortgage. Now with a fixed rate mortgage, you're going to pay the same interest for a set number of years, which means your monthly repayments will remain consistent regardless of the Bank of England's base rate. Now typically people take a fixed rate for let's say 2 years or 5 years, but you can fix for longer, for like 10 years, and there are lenders that can fix it for the whole duration of the mortgage. Now at the end of the fixed period, typically that's when you need to look at remortgaging. If not, you're going to go on to what's called a standard variable rate mortgage, which I'm going to go into that shortly. So what does it look like in terms of pros and cons? So let's start with the advantages. Now your mortgage payments will remain the same even if interest rates change. Now this way you're going to know that your mortgage payments will not increase and go to unaffordable levels during that deal period. Now fixed monthly payments also make it easier to budget and plan ahead, so you know exactly every month on the first or whenever your direct debits come out, you know exactly how to plan for that. And if interest rates do rise, your deal can end up feeling even more competitive against the rest of the market. Disadvantages? Well, you're generally tied in for the length of the deal. So if interest rates fall during that time, you can't take advantage of a cheaper deal without paying something called an early repayment charge, or ERC, you'll probably see it shortened on paperwork. Now, if you need to sell your property before the deal comes to an end, then you may have an early repayment charge as well. And this can be thousands. It's typically a percentage of your loan. So it's 5% of 100 grand. You can do the maths on that. So number 2 is tracker mortgages. Now these types of mortgages track the Bank of England's base rate plus a set percentage. So for example, if the base rate is at 5.25%, then your tracker is a base rate, say plus 1%, your rate is 6.25%. Now, if the base rate goes up, so too are your monthly repayments. And if it goes down, then you might see your payments go less as well. And you typically find if the base rate does go up, it's within 30 days that effect comes into play. Now, sometimes tracker mortgages can come with what's called a collar. And that means the rate can only fall to a set level. This means if the base rate plummets, your payments might not quite follow suit as well. As with fixed rate mortgages, trackers have an introductory deal period. After this, again, you're going to move on to the lender's standard variable rate if you don't remortgage. So to put it simple, the advantages of this type of product are the rates on leading tracker mortgages tend to be a little bit lower than fixed deals. History shows us that they have been. If interest rates go down during the term of the deal, then your payments should, in theory, follow that Bank of England base rate as well. And with a tracker deal, you know your interest will only change if the Bank of England base rate moves up or down, or you come to the end of the introductory period after 2 years or 3 years or 5 years. Now, on the flip side, your monthly repayments will rise if the base rate goes up, potentially making the mortgage unaffordable. So what might seem quite sexy to begin with, in a year or two's time, might be a different picture. Now, you might also have to pay another repayment charge if you want to sell your home or remortgage during that deal period, just like if you were on a fixed deal as well. So moving on to discount mortgages, this again is a variable rate deal that uses your lender's standard variable rate minus a fixed margin, which your lender will outline from day one. So let's say your lender's SVR is 6% and your deal charges the standard variable rate minus 2%, then the pay rate is going to be 4%. So let's look at the advantages and disadvantages of a discount mortgage. So advantages, the best discount mortgages often have a lower rate than the better side of the fixed rate deals. Now, if your lender reduces its standard variable rate during the term of the deal, you guessed it, that means your mortgage payments will fall in line with that as well, bearing in mind the margin that they've discounted it by. And the disadvantages, well, like you could guess, the monthly repayments could rise if the standard variable rate goes up, which can happen at any time as well. And those changes come into effect usually within 30 days if they do. Your mortgage lender isn't obliged to pass on any base rate cuts during the term. So if the Bank of England base rate drops, it doesn't necessarily mean your rate's going to drop. And there might still be early repayment charges if you do sell your home or want to remortgage during that fixed deal period. Now, I've mentioned it a couple of times. Let's talk about the lender's standard variable rate, or as we've said before, SVR for short. Now, each lender has its own SVR and it can be set at whatever level they want. The rate is usually much higher than any rate you'll be able to get on a fixed, tracker or discount, and an SVR is typically the highest rate a bank will charge. Now, SVRs don't come around very often and they don't change very often because they're not directly linked to the base rate. However, they can be affected by it. So for example, base rate goes up by 0.25%, lenders don't have to increase their SVR by the same margin, but many you'll find will. Number 5 is an offset mortgage. An offset mortgage is a home loan where savings are linked in a bank account and are subtracted from the amount of mortgage that you pay interest on, meaning that you either pay less each month or pay off your mortgage balance quicker. So let's have a look at that. If you have 20 grand in a savings account with a bank and it's linked to an offset mortgage of 300,000, then you might only pay interest on 280,000 pound worth of the mortgage. So keep in mind though that your capital repayments is still based on the full loan amount. The offset arrangement reduces the amount that you need to pay interest on, but not the loan itself, which means it still needs to be repaid in full. Now, I know how overwhelming all this information can sound, which is why we've created a handy guide breaking down into little easy understandable bullet points so you can have a look at it, check through the different types of products. We're going to leave a link in the description box below. I'd say I would, but I'm not really going to do it, let's be honest. I'll get one of these too. You can download it for free. How are you going to know which mortgage is right for you? Well, you'll need to consider your income. Is it likely to change? You know, what is your repayment preference? Do you like a fixed amount every single month and do you want to know exactly what you're going to be paying out on? And finally, would you manage it, or would you manage your outgoings if your mortgage payments jumped up higher overnight one day when you woke up? Now, choosing the right mortgage can be a minefield, which is why you should work with a professional advisor. We can search the whole of the mortgage market to find the most suitable deal for you, your circumstances, your preferences, and your thoughts on the overall market. You know, we're going to go through the budget, overall financial position, and recommend a mortgage product that suits you now and what's going to suit you over the next part of the deal, whether it's 2 years or however long. Now, as always, if you do have questions on the products we mentioned in today's video, then please leave them in the comments below. I'll be more than happy to answer them when we get a chance. Now, thanks for watching and I'll see you next time.